Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted today to be able to speak to accomplished fund manager James Taylor of M&G Investments. So, welcome, James.
Hi, Paul. How you doing?
Yeah, not so bad, thanks. Yeah, well, we need some help here because we've had a ton of important geopolitical, macro, and corporate news over the past week, not least Saturday's attack by Iran on Israel in the Middle East, alongside the hotter than expected US CPI last Wednesday and the start of the US corporate earnings season on Friday. So putting all that together, what's your sort of outlook for equities for the rest of the year, particularly a sort of sweet spot of small and mid caps?
Yeah, I think we say we're cautiously optimistic. I think given the run that the markets had into the back end of last year, we thought markets might take a breather at the start of 2024. Been pleasantly surprised at just how resilient they've been, and I think that the rhetoric and certainly in the last couple of months has been higher for longer on interest rates, and the markets have broadly speaking taken that in their stride, which is really pleasing. You obviously touch on the big headlines over the weekend, which is sad news all round. And we run the fund in a style where we try and not take macro perspectives on things. So we're acknowledging of them. We're very aware of them. We try and make sure we don't have unintended bets on the funds. So I think we still remain cautiously optimistic, and certainly what we're hearing from companies is turning more positive, and certainly from a flows perspective, it looks like we might just start to see headway for equities this year, I think.
Yeah, you raise a really good point, actually, because we've had now just recently a couple of profit warnings where the shares have just dipped marginally and then ended the day or ended 2 days. Look, we had speedy higher last week, and it was obviously we had a lot of concern over the weekend on Saturday. The futures were negative, and actually it's recovered pretty well in the small cap sector. Even though you'd expect to be a big sell-off, you've got US 10-year treasuries, the yield increasing, which isn't, that's basically a book. It's a positive macro sign, that is. It's not a risk-off trade. But you're right, there does seem to be a bit of resilience in the market at the moment, even on bad news.
I think so. And I mean, if you go back 12 months, right, we would have seen if you had a company reporting good set of numbers, it would have been started up and traded down by the end of the day because flows was dictating the performance of stocks. Now we are guessing it, even on sometimes weaker updates, and we're seeing some of those today this morning, first of the week, where actually negativity is not being met by a sort of overzealous share price reaction, which is a positive start. And I don't think we can go so far as to say that UK focused funds are starting to see inflows in a material sense yet, but certainly the negativity towards the UK's funds seems to be waning, which is a positive.
Good. Okay. Well, let's run through some stocks. We've got Alphawave IP, which is something that I think a lot of investors have heard about, but don't actually properly understand. Looking at the description, it seems to be a chip design business that specializes in sort of chiplets, which are the building blocks for chips. Sells its IP, and it's largely into networking, fast IP networking. But I don't know if you could expand on that, and also what the sort of investment thesis is behind it, because I don't think it's yet. Is it? I don't think maybe it is profitable, but not massively profitable. Just what's the sort of like what's the investment case for it?
Yeah, so it's a complex one in the sense of so it came to market in I think 2021, roughly I think actually 2 months before I took over managing the super small cap fund. So and I think it came at a valuation of about 3 billion sterling, and was significantly hyped up. The end market was in vogue at that time, and since then it's had a serial number of issues, and the market has sort of put it in the too difficult camp. So we started holding last year. So what's the company do? So the company owns IP, but is also a custom silicon designer, but it specializes in connectivity products. So if you think that the world, in a world of AI and data centers, the sheer amount of data that has to be processed is huge, but we also have to get the data from point to point across chips. And so the IP allows that to happen, but they specialize very much in the high-end networking piece within data centers and between data centers. So it's a niche application. They compete with the likes of Marvel and Broadcom, and there's a company called Credo, which not too long ago IPO'd in the US as well.
And what's that, in terms of their unique sort of like, their USPs, etc., over and above their sort of US competitors. Because when you've looked at sort of the US earnings season, or effectively the Q4 one, the message seemed to be that a lot of AI, generative AI, was being, in fact, a lot of dollars were being sucked into generative AI, and we're moving into sort of like, those, sort of like accelerated computing chips, etc. But networking, in terms of the sort of Cisco's of this world, were quite weak, actually. They'd sucked out budget from those products into sort of like, your generative AI.
Yeah, so I think Cisco also plays into the broader networking with telecoms as well. So Alphawave doesn't play in the telecoms piece; it only plays within the hyperscalers piece. And so
Right.
if you look at where the competitive advantage for an Alphawave sits, it's working on the latest versions and the smallest chiplets and chipsets that are in the market today. So one of the reasons that we became convinced that there was a proper business behind Alphawave when the market sold it off is its relationships with TSMC. And if you go on the TSMC website, you can see that it's actually one of their open innovation partners. And there's only about 40 of these companies that partner with TSMC, but they effectively allows Alphawave to have early access to the latest node, so 2 nanometer and 3 nanometer at the minute, and trial their IP on those systems. And therefore, if you are a hyperscaler in AWS, for example, which is a customer of Alphawave, you want to partner with the leading edge producers at the minute.
Okay. All right. Good. Well, let's move to the other end of the sort of like technology spectrum. Although that's not, I'm not doing a disservice. Hill and Smith, which basically does sort of crash barriers, galvanized sort of steel lampposts and infrastructure. And I think they're booming out in the States. The UK is not too bad. But what's a sort of like, again, what's the attraction to this one? What's surprising, actually, is it makes very good margins, 15% EBIT margins for a, you'd think, a sort of commodity product, but clearly they're doing something which is different.
Yeah, I think that's one of the attractions for this business. I think many people see the Hill and Smith of old, which is the crash barriers and the effectively traffic cones, if you can be really sort of basic about it on the roadside. But actually, this business is now 80% US earnings. 50% of the business is the engineered solutions, and so that is making mission critical steel components that go into infrastructure applications. And when we discuss infrastructure, that's not necessarily data centers, that's wastewater treatment, that's electricity grid upgrades. And as you've seen in the US, there is enormous spend going into infrastructure. So you've had the IIJA, which is a $1.2 trillion package with bipartisan support, and then you've had the CHIPS Act trying to invest several hundred billions of dollars into the semiconductor industry, bringing manufacturing onshore. Many of the components in the engineering solutions division, which again is half of revenues and profits, goes into those end markets. And so if you look at the growth in the recent updates, I think they generated 15% organic growth. But if you look at what the US component within that division did, it's 20%. And if you speak to Alan, the current CEO of that business, they reckon roughly 40% of contracts that fall under those large federal spending plans, only 40% have been awarded, and even less have actually been put into motion. So, we think there is a significant runway for growth here on certainly the engineering solution side, but also on the galvanizing side, where effectively they take other people's steel components and then wrap it in zinc to make it more durable. So that's things like going into bridges and commercial construction, which again, I think the volume growth in the US for that division was 9% at the last read. So I think people get hung up on the roads division, which in the US they are break even at best, slightly unprofitable today. In the UK, there's a okay business. But yeah, we look at it and think expectations in the market are relatively conservatively set. We can bridge it by looking at last year's M&A and rolling through some of the growth levers they've got with them, and then they've got a balance sheet which is 0.4 times net debt at the last read, and they've done some pretty accretive and sensible acquisitions, and we think that continues.
Yeah, I would agree. And I mean, you look at sort of like optically 17.5 times PE, but if you actually think that the forecasts are conservative and you run it as a PEG ratio, given that the infrastructure spend in the US, you probably get a pretty decent valuation, actually, particularly in a couple of years' time. Okay, well, let's move to another one, which came out with news this morning, Synthomer, which is effectively a specialty chemicals business, or it's trying to, and it's sort of restructuring, unbundling. It's sold off a division. It's sold, again, also sold off a smaller business this morning, I think, and has sort of like refinanced its debt. But it's on a mission, I think, to reduce its debt load, its leverage. What is this just a sort of like a beta play on the market? Because if they do it, the shares are going to soar, but if they don't, then they're going to struggle. They're going to need another fundraise.
Yeah, I think you've nailed it on the head, Paul, in terms of there is a significant beta player here on the market, but there is also a self-help story. So part of the reason they have ended up in these problems is due to the prior acquisitions they've made and taking the leverage up on the balance sheet at the what is the top of the market, right? And since then, chemicals markets have been very tough, particularly if you have a portfolio which is not entirely speciality, which is Synthomer. So roughly 55% is speciality, and that's performing relatively well today. But there's 45% which is what you would deem base chemicals. And as demand in China has dropped off, China is exporting effectively a significant amount of byproduct into Europe, which is depressing prices and therefore profitability. The good thing is, I think with Synthomer, there's a significant amount of self-help, both from a cost perspective, but an ability to divest of assets as well. You saw one this morning, so the compounds business. Now, that was only 27 million euros proceeds, so about 5.6 times EBITDA it was sold for. But there's roughly we think another 100 million of sterling proceeds that they could dispose of in the next 6-9 months, and that would have a material impact not just on the balance sheet but also the cash flow of the business. So currently, I think they generated 130 million euros or pounds of EBITDA last year, but 60 million of that got sucked out by interest costs. So if you can materially reduce your leverage and reduce the cost of your debt by having lower gearing and refinancing, that's a sensible way to go, we think. Last week when I was on holiday, I think they priced, they did a refinancing, and what people might miss is they've got a relatively low cost bonds that was coming up to maturity in 25, so that was coming up for a refinancing. They've done that, but they're actually going to take out a smaller bond than they previously had. So the cost of debt was likely to go up. It's actually come in tighter than we expected. So I think they priced in the 7s rather than the 9s, which we had originally planned.
Yeah.
But actually taking a lower quantum out. So, even if the debt cost moved from 60 to 45, that's it's a 3% free cash flow yield improvement right there. So we think if, you ask at the start around, are we seeing improvements in prospects for small caps? I would say Synthomer is one of the ones that did call out green shoots in some of its end markets. So we think we are cognizant this is definitely one of the higher risk investments on the portfolio, given the balance sheet. But we think the self-help, the divestment process, and gradually improving in market, that we could be in for a steady improvement in the share price. And if you look at where we came into the year, I think we're up 50% already. So the market is willing to give it the benefit of the doubt at the minute, we think.
Yeah, I mean, I was quite surprised how an indebted company, particularly in the sort of cyclical industry, chemicals, got away with a 350 million euro bond, 2019, sort of like maturity, senior, at just less than 7.5%. And that says a lot, actually. I mean, how do you view that? I mean, first of all, I guess, would you ever invest in the bonds? If you could invest, I don't know what your mandate is, etc. Or alternatively, how do you read across that to the security of the equity?
So the mandate of the fund is purely equity only, so we can invest in the credit, albeit M&C does have a very large credit business, and we do often discuss with them where refinancings are happen as a read across to our equities. I guess we look at it and go, well, if the credit is yielding 7.5, then your cost of equity is 10.5. But at the minute, this business is on, I suspect it's on about 6 times PE on a forward-looking basis, and probably 5 times EBITDA. But if we're right on the end markets improving and we're right on the free cash flow improving, those numbers will dramatically change, we think.
Yeah, no, it looked very positive to me. Okay, well, let's move to very topical one, Avon Protection, which is an expert, which has gone through its own sort of trials and tribulations, I think, over the past year. But he's been basically an expert in sort of like armored helmets and also gas masks, obviously, and does these rebreathers as well. Largely sells the sort of the military defense equipment to the US, has got some big contracts with the US DoD. Can you take us through this sort of like, the turnaround and how you see it going forward, and whether you, I mean, the shares have done terrifically of late in terms of whether you would top slice or whether you, how would you view the valuation?
Yeah, sure. I mean, if we take a step back, because I think understanding the context of where this business came from is so important. And you can look at the share price chart over a 6-7 year period and go, wow, this, it's down 90% still, and there's huge to go for. But this is a very different business today than what it was, say, 3-4 years ago. And by that I mean there used to be a dairy business within this defence business.
Oh, yes, they
before,
did.
Before my time, so I can't speak to that bit. It also bought a ballistics protection or body armor business from 3M, which turned into an absolute disaster and was not even sold, but it was just shut down. So the earnings power of this business is different to what people may have remembered in the past. What got us really excited by this, though, was the fact that Josh Slater and his team came in from previously at Ultra. Ultra was, I think, the first takeover we had on the fund after I started managing it back in 2021. So we had seen the turnaround that had happened under Ultra before they disposed of that business. And we think they did a very good job there in not dissimilar circumstances. And now you are left with a small defence business with the two divisions, as you put. So rebreathers and masks, and then the helmet protection business. And those businesses are not firing all cylinders by any stretch of the imagination. So if you take the helmet business or head protection business, that's break even at best at the minute. And so the plan by the management team is to achieve a mid-teens margin within that, and we think that's a very achievable margin. It's a healthy margin with a DoD contract, and there's effectively an oligopoly in that market with Gentex in the US, and they have a slight advantage at the minute on the next generation products. On the respiratory side, you've had effectively just a demand lull, but despite that, with some self-help that Joss has put through the business, they're delivering a 19% margin. So when we look at the capital markets day targets that they put out recently, we think they're sensible, should we say, or relatively conservative. And so the valuation today may look optically high, but actually when you put through some of the initiatives that they've discussed, a normalization in demand for respiratory and an improvement in the operating environment for head protection, we think there's probably significant upside to where the market expectations sit today, and therefore the valuation as well. So we bought a position back end of last year. We've not top sliced any. I think it would be some time before we started to reduce our investment there.
Yeah. Well, I mean, there's lots of consolidation, isn't there? There's this whole sector as well. So, and I think a lot of the crown jewels of the defence interests, I mean, like Ultra, like a number of other sort of like, UK military businesses have all been bought out. So, you can always get that optionality at some point. Okay, well, let's move to the consumer sector. Let's go to Premier Foods, which people will know, obviously, if they take a trip down Tesco's. It's ambrosia custard and Mr. Kipling. My wife loves them. What's sort of like attracted you to this? I did notice actually that they've now sorted out their pension as well.
Yeah, so that was definitely one part of the investment case, and we're sort of fortunate on the UK team here of 8 investors to have a pension trustee with some knowledge of how pensions work. So we've witnessed from afar what's happened, right, with some companies once they sort out their pension. Wincanton being a specific example, where the free cash flow massively inflects, and then quite quickly, someone who was interested in the business, the pension problem, comes along and swoops in and takes it for an attractive valuation. So we look at Premier Foods, and it's on, I think, 10 times earnings, 11 times earnings.
Yeah, that's right. Yeah.
Or certainly a 10% free cash flow yield nearly, which for a business that has demonstrated a very strong ability to grow volumes mid-single digit and top line a healthy like-for-like clip and expand margins consistently, and owns a very high quality portfolio of brands, it just feels too cheap to us. And now the pension problem, if you can call it that, has been removed. The free cash flow generation of this business opens up doors to Premier Foods. So in the last couple of years, they have made 2 small acquisitions already. So they did the Spice Tailor for about £44 million, I think, and then they bought a snacking and nutrition business recently called Fuel 10K. What the strategy is here is to broaden the offering away from sweet treats and meals into earlier parts of the day, so breakfast and snacking, and into different cuisines. So we think there's a huge opportunity for them as just a standalone business to continue with an organic profile, but also to layer on top M&A. And at 11 times PE, it just feels wrongly priced to us.
Yeah, and also the brands seem to be, they are different to supermarket owned brands, aren't they? I mean, it's not like cornflakes. These things actually, I mean, I know from my wife's experience, she's tried a Tesco's Mr. Kipling cherry bakewell, and it was horrible compared to Mr. Kipling.
And that's the thing. I mean, they are some wonderful brands, and we've got many of them in our own home as well. We've used the Spice Tailor, Mr. Kipling, all sorts, and they have #1 positions in all of their markets effectively. If you put them up in branded goods against some of the leading FMCG companies globally, they score really, really well in the UK. And the best bit about it is because they've been delivering on time in full throughout the last 5 years to some of the largest grocers. They've earned the reputation and continue to win shelf space.
Yeah, no, I would agree. Okay, well, let's move to the sort of TV sector. We've got STV, which is the Scottish terrestrial broadcaster. What's a sort of like the growth opportunity here? Because people would say, well, linear TV, etc., broadcasting, particularly on the advertising, but it does understand that it's got a studios business and quite an expanding digital arm, hasn't it?
Yeah, exactly. I mean, when we first started looking at this company back in 2020, it was actually predominantly in another role I have, which is working on the UK dividend fund that had a decent dividend yield. And you would have looked at it and said, this is 90% broadcast earnings today. So I think it did roughly 20 million of PBT, and 19 million of that came from broadcast, which, as we all know, and we've all witnessed with ITV, people perceive to be structurally challenged. Since then, you've had Simon Pitts come in, and it's sad to see the announcement that he's going to end up leaving in about a year's time to go on to pastures new. But we think he's done a wonderful job in repositioning this business. So now, if you look at the latest investor strategy they've put out, there's a plan effectively to get to 40 to 45 million of PBT for this business, having done 20 in only 2019. That's fantastic growth by any stretch of the imagination for any UK small cap. And the health of that growth is coming from the digital streaming business with the STV player, so ITVX, it's their equivalent of that, but also a studios business. And the beauty of it is the digital business is highly profitable, and so is accretive to margins as it grows. It's got a brilliant contract with ITV where it shares in the commissioning costs, but ITV effectively run the entire advertising business for them. And so what would have cost STV hundreds of millions to build out, they're just piggybacking off what ITV has invested in behind ITVX. And it's very much a win-win situation where they disproportionately benefit from revenue on the upside and are protect on the downside in poorer markets. And on the studios business, this is a business which has grown both organically but also through M&A, and has really got to a critical mass now. When we first invested in it, I believe it was roughly break even. And now it's going to do high single-digit profits this year, and we think that can also deliver 15 million of profit over the next probably 3 years. And so you're going to end up in probably 25, 26 with a business that is doing 15 million of profit from broadcast, 15 million from digital, and then 15 million from studios, with an attractive growth prospect going forwards. And 45 million of PBT on a market cap today of probably just over 100, I think it is. It's got a small amount of debt, so you're looking at it on 3 times earnings, 3 times EBITDA, and that just feels a bizarre valuation for us, we think.
Yeah, no, I would agree, and I mean, it wouldn't be out of this world either if I ever saw a headline, assuming that the regulators would allow it. But if ITV put a number on these, because they're just basically, it's a replication, but up in Scotland, of ITV. You'd have thought.
Yeah. It's long been muted.
Okay.
God knows how the politics in Scotland works, and the broadcasting and all that kind of stuff. So who knows? Maybe one day.
Wait and see. Okay, well, let's switch sectors to property development and services. Obviously, pretty topical in terms of interest rates. It's been through a bit of a tough period. Let's move to sort of like Watkin Jones, which is a developer of I think it's purpose-built student accommodation, which is traditions, and now move more into sort of build to rent, which is for sort of like affordable homes. But I think they forward sell them to a lot of institutions, and it's been through the mill. I mean, I remember this was sort of like in the high 100, well over £1, and there's now down to sort of like, less than 50p, etc. In fact, I think slightly less than net tangible book. What's your sort of your view and outlook for this business? Because obviously a lot of institutions have been reticent to put money into new build with the higher interest rates.
Yeah, and understandably so, right? If you're committing capital over 10, 15, 20 years to generate a yield or an income for you, you need to have a very clear view on what your cost of capital is. And it has not been helpful for a Watkin Jones to have an environment where higher for longer has existed now for 12, 18 months, longer than we first expected it to. We fundamentally like the sector because there isn't abundance of capital that is desperate to get into alternative real estate, and PBSA or student accommodation and build to rent are still seen as two key areas within the alternatives piece. And so that we're very aware that there's still a significant weight of capital wanting to be deployed. We are just waiting, unfortunately, for a bit more clarity on the direction of rates. And there is still transactions happening in the market. Typically, that's being done on a equity-only basis, and then institutional investors will then effectively recapitalize it later with some debt and take equity back out once they have the sort of cost of funding within their control. Watkin Jones used to do 50 odd million of PBT back in the day, or EBIT back in the day, and now it's come into this year saying we'll be break even based on the prior work that we've got. There's 4 deals in discussions. They've signed 1 this year. I think they needed 3 to get to guidance, and it's a September year end, so there's still work to do. Do not get me wrong, but we're hopeful that the market is slowly thawing, and that the trajectory is heading in the right direction. We look at forecasts and think, this business is not expected to get back to doing 50 million of EBIT ever again. I think it's projected to get into the 30s. So it's not unambitious, but also it's not expecting the world. And there's net cash on the balance sheet, so we are protected for a period of time, providing the market does return. And so we're just being patient investors on that one, I think.
Yeah, in terms of sort of the margins, you raise a really good point, because I was just looking at the forward expected EBIT margins. They're less than 4%, and in its sort of heyday, this used to be over 10% EBIT margins. What would going forward? What would you assume to be the sort of the steady state, sort of through cycle EBIT margins that a business like this should be able to generate? Because I think 4% is pretty low, actually.
Yeah, it depends what kind of cycle you're talking, Paul. I mean,
it's sort of like a normal cycle.
Look, these guys used to make upwards of 15% margins.
And
I guess what we like about it is aside from the obvious fact that markets, real estate, capital markets, and transactional markets are clearly cyclical because people want to deploy capital at the right time. PBSA as a sort of operating business, and you've seen this from the likes of Unite and Empiric in the real estate markets, are relatively counter-cyclical, in fact. And actually, if you look at the rental performance of BTR, that as a asset type is also relatively contra-cyclical. So we still expect through cycle performance to be strong. Now, whether margins ever get back to the mid-teens level, I think we're pretty confident that they can reach 10% again. And I think the thing that people miss on Watkin Jones is too often they're seen as a contractor, and there are various different contractors that earn wafer-thin margins just doing turnkey developments for institutional investors. Where Watkin Jones differentiates is on the planning piece. So they will take land early in the process without planning permission. They'll work with local councils, they'll work with universities to get planning permission, and that's where the value capture sits for Watkin Jones. And then they bring the institutional partner in at the end just to provide the capital. So we still think that they have a competitive advantage in that market.
Yeah, no, it does look like a very interesting recovery play. There should be no reason why they can't get back to at least, normal through cycle margins. And I know the guy who set it up originally, Watkin Jones, and he still owns, I think, a slug of shares. So you can guarantee behind the head, he's helping the board get the business back into shape, I'm sure. Okay, well, another one in that property sector, but slightly different, is LSL Property, which I think sort of like has a franchise estate agent model, but also does a lot of sort of like mortgage, provides services to mortgage intermediaries and this sort of stuff. And it seems to have a pretty resilient business model, actually. The shares have done okay.
Yeah, well, it's a much more resilient business model than it was 2 years ago. So you picked up on the point around the franchise estate agency, and they actually used to own estate agencies, and that's where the huge cyclicality came into the business.
Yeah.
So for those of us on the podcast that live in London, there's Martin Parsons was one of the big ones in southwest London, and as we all know, estate agencies are good businesses in the good times and terrible businesses in the bad times, and unfortunately for LSL, it wasn't managed particularly well either, and so they've actually managed to release a significant amount of capital from that business whilst franchising it, which has reduced the cyclicality. This is still a cyclical group overall, but it has reduced the cyclicality. And then you're left with two businesses effectively beyond that, which is a conveyancing business where they're the market leader in providing surveys and valuations into mortgage lenders. So Lloyd's being one of their biggest clients and biggest lenders in the UK. And again, they've done a significant amount of self-help in this business where they have changed the employee footprint of the business. So there is a certain amount of people who are employed, and then they outsource a certain amount of work, so that when the volumes aren't there, they aren't sitting there with a huge cost base and therefore operating leverage. But when the market comes back, they can fill their own employees up first and then bring in contractors on the latter part. So that is highly profitable if you look at the numbers. And then probably the most exciting part of the business is the Primus platform, which most people in the market probably know Mortgage Advice Bureau, and this is the competitor to them. And actually, if you look at share of lending, they actually have a higher share of lending than Mortgage Advice Bureau do. So there is we think, a really attractive business in here. We think there's probably a little bit of investment to go, but it just seems to fly underneath the radar, LSL. And at the valuation, big discount to Mortgage Advice Bureau, we think it's a pretty attractive hold here.
Yeah, no, I would agree. Actually, I didn't realise it had that information part to it as well. Okay, good. Let's move to advertising and media. We've got a sort of like a battleground stock. This one, M&C Saatchi, in its heydays. It was the sort of like Labour isn't working slow back in Thatcher's days, and that's sort of its high. And it's sort of like sort of expanded and then got into a bit of trouble, etc. Anyway, it sort of attracted a couple of bids about 2 or 3 years ago, and I think one of the people who put a number on them has still got shares. That's Vin Murray, etc. What's your sort of your outlook for this business? It's certainly not expensive on 9 times. PE, and it's got a bit of net cash, etc. So you'd say, so on the surface, it looks a lot of bad news is already priced in there in terms of the dampness of the advertising. But can they get back to what they used to do?
Yeah, I mean, you touched on exactly the points that we've all thought about internally at M&G. So we observed the two bids. The one was from Next 15, and the other one, as you say, was from Vin Murray's ADVT vehicle, which still owns, I think, roughly a high teens percentage of the business. And that's for a substantially higher price than the share price today. So we took note of that and started doing more homework. We then noticed Zilla join as chair, and we knew her from Future PLC, and we could see where the investment case might go. It looked like a business that had probably too much cost, and so it's no surprise to us that one of the first things Zilla did was move pretty quickly to reduce the cost base, exit some of the unprofitable or very low profitability businesses. And so there's been a string of RNSs recently around exiting peripheral regions where there is either a lack of scale or lack of profitability. But fundamentally, I think within M&C Saatchi, there's some really, really attractive businesses. We'll come back to the core advertising business, which is where the cost issue has sat. But outside of that, you've got things like passions and influences, where effectively they're working with influencers, and then they work on things like social issues and with with NGOs, non-governmental organisations, the UN, NATO, the British government, where they've got carved out quite an attractive niche and earn very high and excellent margins. So we think there's a core part of the business where there's a self-help story, and then there's another part of the business where they've got verticals with really attractive like-for-like growth happening and strong margins. And whilst we can't predict when the advertising market will return by any stretch of the imagination, they've got a very clean balance sheet now. Most of the put options that have been a headache for investors from prior M&A are going to wash out in 2024. And so again, you're paid to wait on a very, very low valuation with evidence that people think it's worth significantly more, who are industry experts, with some really attractive assets in the group.
Yeah, no, it did seem to have a sort of like a oldie worldy type of, I don't know, old boys type of culture, which just needed to sharpen up and get in, and a lot of self-help. And so I think Zilla is probably is exactly the right person to just for investors. Why did the two competing bids fail? Because you'd have thought with a competitive, it's surprising that it did, at least one of them didn't win.
Yeah, so we weren't invested in it at the time, so I slightly hazy on the memory. I mean, it's sort of music to my ears, to be honest, that bids have failed, because I think we're still seeing a huge number of bids in the UK, and not every single one of them we're particularly pleased about. So it's nice that a board and a management team can feel that they're confident in rebuffing them that it's the wrong price. I suspect, and I would have to double check this, Paul, I suspect it came down to valuation, to be honest.
Yeah, okay. That sounds like having your cake and eating it, that does, James. Wanting it anyway. Okay, well, let's move to another sector, slightly more on the sort of consumer, but let's go to gambling. We've got 888 Holdings. And again, it's really a bit of a sort of like a giant in online gambling. And then a few years back, I think, bought the retail estate for William Hill, the shops in the UK, to try and do online and to do the physical side. And that, unfortunately, laden them with a shed load of debt. And I guess the same thing is to reduce that. How do you view it in terms of, obviously gambling businesses are hugely cash generative, but they've got a bit of a mountain to climb here?
Yeah, so maybe one slight clarification. So in terms of the William Hill assets that they acquired, so that was back in I think it was early 22 now. So it wasn't just the retail estate from William Hill, it was the non-US, or what they would have called the international assets for William Hill. So it was the online portion as well. And we invested, unfortunately, very early into this story for AAA and William Hill, because we'd done a significant amount of work around prior M&A or mergers in the UK gambling space. And there is enormous accretion and enormous value to be had, particularly when you bring together a iGaming or casino-led business with a sports betting business. There is enormous synergies, particularly on the cost side, but also from a revenue side as you cross-sell between players. So the industry logic was there for us. These businesses are highly cash generative, so can potentially run with a decent amount of leverage. But the frustration for us, and for all investors, and the reason why the management team has now changed, is they chose not to issue the equity that was required at the time of announcing the takeover. And the problem is, if you don't do that at the time, people know that there is still going to be an equity issuance at a discount in time to come. And so people don't buy the shares today and buy them cheaper later. So buyers disappear from the market, sellers take hold, share prices fall. And then as the share price fell, you still have to issue a discount. So then for the dilution from issuing more shares to make up the same amount of absolute equity raise becomes ever greater. And then people start shorting the company. And then, unfortunately, the management team decided that actually, to get around this problem, we're just going to issue less equity and more debt. So the balance sheet became even more stretched, which was music to some people's ears that don't necessarily want share prices to go up. And so he ends up in this massive problem. And then to make it all things worse, I think the prior management team decided to fix the cost of debt in, I think, November 22 during the trust periods when, bond yields had blown out. I mean, it was a recipe for disaster. Fool us for not selling the shares sooner, to be honest. So our investors, our client base has borne the brunt of that, unfortunately. we still think there's a huge amount of industrial logic behind this business, but it is a question more now about growing their way or growing the EBITDA enough that the leverage comes down to a point where in 27 and more, principally more 28, when the debt comes up to refinance, that actually you can refinance at a much lower cost than the sort of double-digit yield on their debt today. So it's been a very painful process, that one. But ultimately, it's a very profitable business at the EBITDA level. It's it's the capital structure and what's happening to that EBITDA, which means it doesn't fall to shareholders. I think to put in numbers around it, I think they generated 330 million ish of EBITDA last year, and EBIT was 30. And 170 of that goes to interest costs. So if you could just half your interest bill through delevering and reducing the cost of debt, the free cash flow improvement to this business is enormous. So we're pleased to see a new management team in place there. They brought out targets before I went away on holiday, so 2 weeks ago, I think. And I think the relief in the market is that it wasn't another big reset. So I think the market is in a sensible place now. But we're going to have to be patient on that one for sure.
Yeah, I think you're right being patient, no doubt about it. I mean, this would not surprise me given the amount of consolidation. A private equity buyer used arbitrage as the interest rate, because obviously it's 10%, just over 10% is what their yield is. Their bond yield.
Well,
and
I mean,
therefore,
we saw that, Paul. So I mean, there's been rumours of takeovers on this one. So for those that have followed the story, there's been two apparent approaches. So you've had Playtech that apparently, according to Beatville, were willing to pay 156, I think it was, at some point last year. So that's doubled the current share price. And then there was a consortium of investors that started building a stake, and it was Kenny Alexander, the old GBC CEO, or now Entain CEO, from years gone by, and he was. Let's just say there was controversy around those individuals, and so I think that was put to bed relatively quickly.
Yeah, well, it generates. All we know is it generates a lot of cash, and if it sorts out its balance sheet, it's got a great look. It's got a great future. So somebody will sort that balance sheet, or if it has to, it'll have to do it itself. Okay, another one that's slightly smaller in the gambling sector is Gaming Realms, which I think licenses out its Slingo mobile sort of gambling app, which is a combination of sort of casino slots and bingo, etc., sort of low value, but has actually done really well in terms of winning, sort of clients and people who are licensing out its products. Do you want to take us through this one? Because the revenue are up 26% and licensing revenue is up 33%, and it obviously makes excellent margins, 32% EBIT margins. So they're doing something right here.
Yeah, and this is a business that has had a great 3 years. So that 26% licensing growth is not a new number this year. They have been compounding the licensing business, which is, I think, roughly 80% of the earnings of the group today for some time. And that is not, many people say that's just the US market becoming regulated, and therefore you can enter there, and that's a huge opportunity. But actually, if you take the UK market for them, that also grew in the 20% last year, or at the most recent update. So the format for this business is increase the number of games. So there are, I think, 75 games today, and that was up from 70 last year. And then increase the number of operators that you license to. So if you look on the slide deck, you'll see everyone from William Hill, 888, Bet365 in the UK, through to operators across many markets: Italy, Spain, soon to be Greece, Lithuania. They're in Canada, the US. So there is significant white space for them to continue growing, both into new geographies but new operators. So I think I'll say two things. One, the margins look incredibly healthy on this business, because this is a scale game. You create the game once and you sell it multiple times. And Slingo as a format of games travels extremely well. And so you'll see on some operators' websites, Slingo actually holds a completely separate tab to casino, etc. So it clearly has good real estate in the gambling operator world. It does spend money developing those games, though, and so the 45% EBITDA margins you see don't necessarily always translate into
Yeah, okay.
free cash flow. So, but that said, the EBIT margins are still well in the 20s if you capitalize the R&D and put that through the P&L. So this is still a highly profitable business. It's got a net cash balance of, I think, 7.5 million, and many people have that growing to double digits next year. And I don't know what the market cap today is at 80, 90 million.
Yeah, that's right. Yeah.
And so, in 6-9 months' time, we're going to have a business with 15% of the market cap in cash, and they're going to have a question. And I think, I'm actually meeting Mark later this afternoon. It'll be one of my questions for him. What are you going to do with it? Because, it's not earning much sitting on the balance sheet today. They could either go and buy more game content and put it through their own hosting service and sell to the operators because they've got connections with all the operators. So that's the competitive advantage. Or they could, pay a special dividend. I suspect, given the liquidity on the shares, a buyback is not going to fix problems for them. But we think there's a very healthy runway for growth here, decent cash generation, and a very healthy balance sheet to go with it.
They probably need to buy another title, I would have thought. I mean, I know they're doing a lot of their product development on stretching out or expanding and broadening out the sort of Slingo brand. But if they had another brand, then it would be they'd probably have a lower cost to capital as well in terms of the investor look, because you wouldn't be just betting on a sort of like, one name.
I completely agree. With the connections that they've got with the operators, that's the advantage. There's many small studios out there that develop games, but the access to the market is the difficult thing.
Yeah.
And so if they can use what they already have, then I think that makes eminent sense.
Yeah. Good. Okay, well, let's switch to another sector. We've got Videndum, which is the old VTech business, does sort of professional sort of content creation, cameras and this sort of stuff. Obviously, they suffered a bit last year in terms of the actors strike out in the US and the directors strike then. And now you've got sort of people worrying about sort of regenerative AI and how that's going to impact the whole video creation. What's your sort of outlook for this? Because they've got a bit of debt that they need to pay down, but they do have a quality brand and a quality product.
Yeah, I completely agree with you. And in many cases, their products have very, very strong market shares, upwards of times 40%.
Yeah.
The simple answer to your question, Paul, is I don't know on the AI piece. I know it'd be easy for me to come in here and say some nice fancy words, but I'm not sure who does know exactly how AI is going to play out. I don't think the company knows themselves, to be honest. So all I know is that I don't think it plays out over 1 year. This is a long-term topic for discussion. Now, the industry has faced radical change before, be it animation and robotics, etc., and Videndum has always been able to navigate it. Whether AI is a bigger issue than before, we don't know. Now, as a consumer, I love going to the cinema, and I love going to cinema because I want to see the best actors in the best movies. Now, I'm not sure if we enter a world where everything is AI generated and, forget Tom Cruise and the likes and the latest Maverick film, it's all going to be an AI generated figure. I don't know. So we're sort of in that wait and see camp rather than we're not going to throw in the towel. You got to remember this business, the content creation division is actually the smallest proportion of the business today, albeit it is a large part of the growth story for them. But you still got the media solutions business, which sells products to consumers. I still think that has a healthy future there, and that's 50% of revenues. And then you've got the production business, which, again, I hope in the future we're still going to see live sport, live entertainment, which will require camera equipment being used rather than everything. We're not going to have AI generated sport fixtures, one would hope. So there is still a future for this business. It is harder to decipher today than it was 18 months ago. I think we've all seen the AI generated videos from the company called Sora. And it's fascinating. It's wait and see. Unfortunately, I don't have all the answers on that one.
Yeah, it's quite interesting actually what you raise, because obviously Mark Zuckerberg at Meta, he bet the house originally on the metaverse, and that has not worked simply because people have not wanted to go to a virtual environment, largely because the interface actually is not great. But there's also other things. As you're right. I mean, would I choose between live sport or watching simulated sport? Well, it's an easy one, isn't it?
Yeah.
Yeah. Okay, good. Well, let's move.
The other thing
Okay.
I'd say on that one, Paul, though, as well, is you know, the writer's strike or the actor's strike that happened in Hollywood, and finished, I think, December last year. And so we only just started to come out of that, which is why the recovery has been somewhat slower. Let's not forget that within those agreements with the studios, there were protections put in place for writers and actors in regards to the use of AI, and those agreements will stand for, I think it's between 10 and 15 years. Now, I don't know the factual details of all those, but I think we can see that there will be a roadmap where AI is integrated into production studios, but it's not going to happen overnight.
Yeah. Okay, good work. Let's switch to another company. A bit of a special situation, actually. Going through a bit of unbundling is Trufin, which has got 3 divisions. It's got PlayStack, which is its gaming platform, but there's sort of really 2 interesting ones. I think it's got an early payment sort of like discount business, and there's another similar business that it owns as well.
Lending as a service with
Lending as
Synthomer.
a service, yeah. Do you want to take us through this one? Because just recently sold, didn't it, Virtus? But its biggest division, or had a bid over Oxygen, I think, at sort of like last year.
Yeah, so if you came into this year, I think Trufin was priced at 50p, and Oxygen had a bid at just shy of 30. So
yeah,
we're always very careful with some of the part stories that there is actually a roadmap to realizing the value that people discuss, because too often in some of the parts it's an excuse to hold on something which is too cheap. But unless there's a way of actually realizing the value, it's going to remain that way. With Trufin, we think there is a roadmap to realizing the value. On Oxygen, we've seen the demonstration that it was worth just shy of 30p, or half the market cap at the start of the year, a little bit less now after the run it's had. But what we like about Oxygen is the fact that the growth has massive visibility in terms of, you have local authorities being onboarded onto the platform, and they typically stay there for at least 7 years. But the spend that goes through from the local council takes multiple years to ramp up. So we know from previous cohorts that their spend in the next 2-3 years is going to increase through Oxygen, and therefore the revenue will increase for Oxygen as well. And then the incremental margins for Oxygen are very, very high. So the profitability should ramp pretty materially as revenue drops through to the bottom line. The thing I think some people have missed maybe on Oxygen is the fact that the 2 largest competitors of Oxygen exited the market in 2023. And so you'll also see, and I know James has been on your podcast before, James will have talked around investing, I think, £1.2 million in Oxygen this year.
Yeah.
I think headcount has gone from 15 people to 72 people. Now, if you join the dots between the competitors exiting the market and investing in headcount, you might think that they're going after significant growth opportunities from customers that they don't currently work with, moving over to Oxygen. And as we said, if you put the revenue through, the profit drop through is material for this business. So Oxygen does, I think, one and a bit million of EBITDA today. We think there's a very clear roadmap to 5+ million EBITDA. And given it was worth 29p at 1 million of EBITDA, what's it going to be worth at 5 million? So we think you can get most of the market cap back from Trufin today just in Oxygen. Synthomer is earlier in its journey, both in terms of revenue and profitability, but it's clearly got these large contracts with particularly Lloyds Bank, and they'll be embedding more of their customers through 2024. They won the contract to work with Bank of Ireland, I think last week when I was on holiday, or maybe the week before. So there is demonstration here that the product is working, and they have built it in such a way where it's scalable globally, not just with one bank. So there's significant progress there, and our best guess, and we don't know any more than anyone else, would be that in time, PlayStack gets sold to another indie developer, a la Team 17 or something. Oxygen gets sold to one of the bidders that originally tried to buy it, and then you've get left with a lending as a service software business with key clients in Bank of Ireland, Sage, and Lloyds. And we think there's an easy way to get to the 70 odd p of the share price today.
Yeah, I would agree. I think at the right moment, there's a lot of potential catalyst there, that's for sure, for value creation events. Okay, well, you mentioned Team 17. Let's move to that one. That has been through the mill, obviously. It's sort of like one of the UK's best or biggest sort of like software or games developers. Does its own titles, but also does a bit of outsourcing, I think, for others as well. Can you take us through this one, because it did actually attract quite a little director buying at about 185p some time ago, and now it's traded at 250. But it's still a long way back from its heyday in 2021 when everybody was locked in, indoors because of the pandemic.
Yeah, exactly. And look, I think many people would agree that the market maybe got ahead of itself back in 2021 and extrapolated growth rates for too long that were unsustainable. Team 17 then compounded that problem by, I guess, style drift, in the sense of, but like a fund manager might try and move from a growth to a value process. These guys move from indie development to doing blockbuster AAA games. And unfortunately, if you get those wrong, there's significant cost overruns and the revenue doesn't come through and your profitability takes a massive whack. Now, there's been management change there and the new CEOs come in, and it's very clear that Team 17 will revert back to its original focus of indie development, where you're typically investing tens, hundreds of thousands in games, maybe $1 million, but we're not investing 15-20 million pounds betting the house on a small number of games being winners. I mean, the sell-off in the shares on the final profit warning back last year was astronomical. I think the shares at one point were down 50%, and that's when we started to build a position on M&G's funds. I guess what we like about the business is you've got a rock solid balance sheet for the time being. I think there's roughly 40 million of net cash.
Yeah,
and it's
right.
it's a cash generative business, right? So that we expect that balance will still go up from here, not down. We actually like the acquisitions that they've made in recent years. So Story Toys, which is the kids' edutainment business, which we know is a growing area of the market, and then Astragon, which is the simulator business, look really, really sensible acquisitions. And one of the reasons we like them is because they are, I guess they're not blockbuster games in a sense, but also they have good lifetime value. And by that, I mean that it's not just about the customer buying the game up front, it's about the customer then buying add-on packages. So if you think of an entertainment game, a kid may acquire it, complete it, but then you can increase the level of difficulty that comes with entertainment games. If you look at simulation games, you can add in, if it's flight simulator, you could add in new flight routes, new airports, new planes, etc. So I think there's a very sensible strategy here of building lifetime value in the back book of business behind Team 17 rather than going after home runs. And I couldn't tell you what the valuation is today, probably 10, 11 times earnings.
Yeah, well, it's about 8 times EBITDA, which is pretty cheap, really.
Yeah, for a business which their market grows high single digit and the margins are very good, that feels a pretty compelling valuation to start the journey.
Yeah, no, exactly. If they can get anything, back to where to where they were, then certainly that will build sentiment and bring investors on board, because it does look, certainly optically very cheap. That's for sure. Okay, let's move to Ascential, which has gone through its own unbundling exercise, sold off. It does it sort of like it was into data for B2B data services, but sold that off, got a lot of money, and has gone through. I think it's returning a lot of money to shareholders, and is now a sort of premium global events-led business with a couple of good franchises. Take us through this one in terms of what you see in it, particularly going forward in terms of sort of the growth, or whether now that the value creation has happened, you'd be sort of taking profit off the table at all.
Sure. So if we just think about how they're returning capital for a second, so there's a 450 million pound special dividend due to be paid in the coming months. They're doing a 300 million pound tender offer. And once that's complete, they're going to do, I think, 100 million pounds buyback on top. So net, the buyback's going to be offset by a share count reduction of a similar magnitude. And so that's 850 million pounds back to shareholders one way or another. And then you're left with a business which, as you say, is largely 2 events. So you've got Cannes Lions, which is widely considered the sort of Oscars for the advertising industry. And then you've got Money 2020, which is a fintech and payments conference exhibitions business together. And if you look at it post central costs after the demerger, the business is going to generate we think around 69 million of EBITDA.
Yeah.
And so I just look at, and we've owned events businesses in the past. We owned Hive, which got acquired by private equity. But I mean, there's not many businesses in the event space which have lasted as public companies. They seem to all get taken private, and valuations have been upwards of 12, 13 for really good assets. It's 15, 16 times EBITDA. And we would look at Ascential's portfolio, and be it's a concentrated portfolio, but we think they are market leading assets, and you can see that in the EBITDA margins that they generate are very, very healthy. We still think that there's growth prospects for both of them. So Money 2020 is relaunched in Asia. There is a significant opportunity in Asia to grow the business. I mean, just the sheer number of clearly people and wealth and spend that's going to increase over the next decade. And it's significantly more fragmented than payment markets in Europe and the West. And so there's a big opportunity to grow. US had a tough year last year because of the fall over in fintech world effectively, and Silicon Valley Bank collapsing. So we think there's a recovery to play out over the next couple of years as well. So we're excited by the organic prospects of Ascential's events. The balance sheet is going to come in a sensible position. I think 1.5 times net debt, which these businesses are highly cash generative. So there's 3 plays on Ascential. One, the organic assets will grow nicely and generate a lot of cash for shareholders. I think the cash can then be recycled into acquisitions and expand and diversify the portfolio. And if it can't do either of those, I suspect someone will come along and do what we're seeing a lot in a minute.
Yeah, take it off the market. Yeah, I think you're probably right. Okay, well, let's move to sort of asset managers. We've got Tatton Asset Management that I think really is more of a platform, actually, helping out IFAs and sort of like people, intermediaries who do sort of like, mortgages and stuff like this. But can you take us through this one? It's not as cheap as sort of like most of the asset management space. So there's obviously they're doing something different. And the other side of the coin is they generate EBITDA margins. I was just looking at that at 50%.
Yeah, it's enormously profitable, and it does speak to they are doing something completely different or very different from the rest of the pack. It's not cheap on a headline basis, and I think actually it's probably the most expensive stock on the funds I manage at 22, 23 times PE. Now, in simple terms, what they do is they provide a managed portfolio service, and in simple terms, advisors or independent financial advisors have historically either done the discretionary investment piece themselves, and that's an exciting part of the job for many people. The FCA though has clearly been taking an increasing focus on consumer duty as a topic and ensuring that end clients are getting value for money from the investment piece. And for many reasons, fees charged by fund managers have been high but reducing. Performance in some aspects has not been good enough, and therefore the model for IFAs has been to outsource the discretionary fund management, the DFM piece, to an outsourced provider. And increasingly that outsourced provider is an MPS solution. So if you look at the market today, I think there's about just over 600 billion of advised assets on a platform. So there's more off platform, but the on platform piece is 600 billion. Today, about 17% of that is sitting in a managed portfolio service. If you go back to 2017, that was only 5%. So MPS has rapidly grown over the last 6-7 years. And so it will continue to grow ahead of the market, and Tatton will grow ahead of that as well. So if you think what Tatton does MPS, but it only does it on platform. So already you've got the end market for advisory growing low to mid single digits as people build wealth. The on-platform piece is growing faster than off-platform because people are shifting more onto the platforms, and then people are also investing more into MPS than other discretionary fund management propositions. And Tatton are the market leader, so they've got roughly, I think, 15% market share of the on-platform MPS solution. And it's a scale game. So you remarked around the margins pool. I think it does high 50s at the group level, but the MPS is about 80% of what this business does today. So the margins in the MPS piece are in the high 60s. And I suspect they'll continue to ramp. Now, at the minute, clients pay 15 basis points to access on average the MPS solution by Tatton. They are towards the tighter end of the market. And Paul, who founded the business and still
Yeah.
manages it, has always said that they will be towards the leading edge of the market on price. They won't lead the market down, but if people choose to go there, that they will continue to be the best for the customers. And so I think for regulatory reasons, there's a very strong tailwind for this business to continue growing in the double-digit rates. And bizarrely, whilst we all talk about flows being negative in the UK, if you look at the flow dynamic that Tatton have experienced over the last 2 years, they've been growing flows double digits in the last 12, 18 months. So it's a really, really healthy backdrop for them.
Yeah, you're right. I mean, the economies of scale and the positive leverage on this thing are terrific. They don't actually run their own sort of branded funds. They benefit from the growth overall in the asset management industry and have more sticky recurring revenue streams through their IFAs, their thousands of IFAs on their platform. Okay, good. That's fantastic for the insights. When would when do sort of M&G decide to sell, or when do you decide to sort of pull the trigger on a stock and you've had enough?
That's a great question. I'm not sure we always get it right. It's fair to say we don't use price targets. Momentum is a huge factor, particularly in small cap investings, and you want to capture as much of that momentum as possible.
Yeah.
And having a price target, we find typically limits that. Now, it's a price target is useful in terms of top slicing, but having an absolute sell decision based on price target we found is unhelpful. More often than not, we're constantly trying to test whether our investment case is broken. And sometimes that is hard emotionally to decide. But that's where I've got Hilary, who works alongside me, and we're a team of 8 investors that provide a sensible and constructive level of challenge across the UK desk here at M&G. And so that is one factor that plays into it. But equally, if we look down the portfolio, we've got some higher conviction stocks. Hill & Smith is the largest one in the fund today. M&C Saatchi will be up there. And then at the bottom, we'll have smaller weights. And either those are holdings we are currently trying to build up, or those are stocks that have ended up there. And you've constantly, as a portfolio manager, got to question your tail. And is that the best use of capital? And if something is 25, 30 basis points of your fund, that's not big enough to really contribute meaningfully to your return. So unless you're willing to double that, treble it, that probably tells you a lot about where you are in your process and investment case. And that's the I guess the emotional process that we go through. Fundamentally, we're very relative valuation driven, and so whilst things may have moved up towards what other people call price targets or fair valuations, unless we can find something else, an opportunity cost that's something else which is materially cheaper for us to buy and better, then why would we sell something if we can't reinvest it elsewhere? Clients ultimately have asked us to run a UK smaller companies equity portfolio. So we don't try and run the funds with 10, 15% in cash or anything. We try and stay largely fully invested, but buy the best portfolio of growth equities that we can at a sensible valuation.
And what about the mechanics of if you ever did come to sell a sort of like a small cap company, etc., maybe less than 100 million or 150 million, just getting the liquidity now? How do you do that?
It's been a fascinating journey taking over a smaller companies fund in the middle of 2021. I think what I describe as 5 weeks of the bull market, and I've had 2.5 years to 3 years now of the bear market. And liquidity has been a major factor in how people need to manage their smaller companies' portfolios. Now, we have benefited at M&G with the fact that the fund has not had the level of outflows that other funds have had. We have also never managed this fund though with a long tail of highly illiquid stock. So I think the smallest ones we've talked about, so Trufin, Gaming Realms, STV, are probably the 3 smallest names on the fund, ironically, and we don't have many more. So we've always tried to manage the fund in a very sensible way where we're never going to have a liquidity requirement. But you're right, if you do decide that your investment case is broken and you want to sell something, it can be tricky. And that is always something that you've got to factor into your investment case and the price you're willing to pay on day one for something.
Yeah, I mean, I run my own money, and just selling sometimes in small cap companies, 50 grand's worth of a share is like, wow, no, the market won't take it. It's all like, this is crazy. Okay, brilliant. Well, thanks again for your time there, James. If somebody wants to invest in the M&G small cap fund or other M&G funds, etc., how best to do that?
Well, so I think compliance would ask me first to say, make sure you take advice if you need it,
Okay, yeah,
and then once that's been ticked off and you know what you want to do, I think the M&G funds are available on firstly the M&G website, but across all the major platforms. I won't name them, but
yeah,
everyone knows
sure.
who they are, and yeah, I mean they are widely available, which is good.
Okay, well, thanks again. Very generous of your time, and I know investors will really greatly appreciate all the insights you provided there. So, thanks again, and look forward in touching base in 6 months' time.
Pleasure, Paul. Thanks for having us.